Interest rate swaps, IRS, a comprehensive overview. 1. Definition. An interest rate swap is a financial derivative in which two parties exchange interest rate cash flows, typically one fixed rate payment for a floating rate payment or vice versa. 2. Purpose. Risk management. Primary use is to manage or hedge interest rate risk, providing protection against fluctuations in interest rates that could impact cash flows, liabilities, or investments. 3. Parties involved. Fixed rate payer. Commits to paying a fixed interest rate. Floating rate payer. Commits to paying a variable, market-determined interest rate. 4. Mechanics. The parties agree to exchange interest payments based on a notional principal amount. Payments are calculated periodically, often semiannually or quarterly. No exchange of principal occurs. It's used for calculating interest payments. 5. Types of interest rate swaps. Fixed to floating swap. One party pays a fixed rate, and the other pays a floating rate. Floating to fixed swap. The opposite arrangement, where roles are reversed. 6. Calculation of payments. Fixed rate payment. Notional amount times fixed rate times time. Floating rate payment. Notional amount times floating rate plus spread times time. 7. Notional amount. Represents the hypothetical principal amount upon which the interest rate payments are calculated. It's not exchanged but used for calculation purposes. 8. Interest rate benchmarks. Common floating rate benchmarks include LIBOR, London Interbank Offered Rate, Euribor, Euro Interbank Offered Rate, or other market-determined rates. 9. Benefits. Risk mitigation. Allows parties to manage exposure to interest rate fluctuations. Customization. Tailored to specific needs and risk profiles of the parties involved. Cash flow management. Can be used to match cash flows with liabilities. 10. Risks. Basis risk. The risk that the floating rate used in the swap is not perfectly correlated with the party's actual funding costs. Credit risk. The risk that one party may default on its payment obligations. Market risk. Changes in interest rates impacting the valuation of the swap. 11. Terminating an interest rate swap. Can be terminated through mutual agreement, reaching the maturity date, or triggering certain predefined events, e.g., a material adverse change in financial condition. 12. Accounting treatment. Generally follows accounting standards like International Financial Reporting Standards, IFRS, or Generally Accepted Accounting Principles, GAAP. 13. Regulatory environment. Regulated by financial authorities to ensure transparency, fair practices, and risk management. 14. Use in corporate finance. Companies use interest rate swaps to manage interest rate exposure associated with loans, bonds, or other financing instruments. 15. Role in financial markets. Widely traded in over-the-counter (OTC) markets, contributing to liquidity and price discovery in the interest rate market. 16. Challenges. Complexity. Understanding and managing interest rate swaps requires financial expertise. Market volatility. Changes in interest rates can lead to valuation adjustments and impact the effectiveness of the swap. Interest rate swaps play a crucial role in the financial landscape, providing a flexible tool for managing interest rate risks in a variety of financial instruments. As with any financial derivative, parties engaging in interest rate swaps need to carefully consider the associated risks and ensure compliance with regulatory requirements.